Hi guys, today we're going to go through exercise 7.7, which is a question that asks you identify an inventory loss or gain, but it is more complicated than the one on 7.6. You'll find the workbook template, which you can see on this screen anyway, which is in your workbook at 125, and the textbook at 147. So you should have both open, but you can follow just by watching this video as I've put the question up on the top left-hand corner of this question. What are you asked to do here? You're asked, if you look at A, you're asked to prepare the inventory account as it would appear in the general ledger. So you should, using all the information above the question, record any of that impacts the inventory ledger. To do that, we're going to need to look at all of this information and identify, is it impacting inventory? And has it impacted inventory to increase it or decrease this? And to do this, we're going to need to use our old friend Paler to do some analysis. And we're experts at this now. We know that if we write Paler, we can think of an increase being above the line, a decrease being below the line, and typically the one that we remember is an increase to an asset is a debit. So if an increase to an asset is a debit, a decrease to an asset is a credit. And this is really important because we know in this question the general ledger is inventory and we know the general ledger is an asset. So if we find an increase to inventory in this information, we're going to do a debit, and we know that debits equal the left-hand side, debits equal left. And if we see an decrease in inventory, it's going to equal a credit because credits equal right-hand side. Just so we're clear, we can fill in this by keeping the pattern debit, credit, debit, credit, debit, credit, debit, credit, debit, but we don't need any of that information because the only question that we're interested here is our inventory ledger. Yes, there'll be other ledgers impacted by these transactions, but when, like a lot of questions in accounting, we're not asked to record all of those. So let's go through this. Let's go typically from top to bottom to think about which of these transactions impact the inventory ledger. Does it increase it or decrease our inventory? And then what might be the other side of the transaction, because that will be our cross-referencing. And remembering our cross-referencing, I'm going to write this here. Cross-reference. Cross-reference is the other side of the transaction. So if we are going to do a credit on inventory, we're going to need to think what was the debit that resulted in that decrease in inventory. Let's run through the 6 transactions here 6 bits of information that might impact inventory. The first one here is the balance of inventory at the 1st of July was 17,500. Obviously, this is talking about inventory, so we must record it in the inventory ledger. What is this saying? At the 1st of July 2022, and remember our textbook assumes essentially that we're in 2023 to allow the textbook to be relevant for a number of years. At the start of the year, start of the balance date, inventory is 17,500. If we have a balance of inventory, that means we have positive inventory. We have got a ledger at the bottom that assumes nothing at the moment. So we're going from 0 to 17,500, and 0 to 17,500 is an increase. An increase in inventory is a debit. What was our date that we do this here? As you can see, it is 1 July. We don't have any other opposite side of this transaction because it is purely the balance. So we can remove that cross and tick off the first one. Over the course of the year, Classic Trophies has done credit purchases of $52,000 plus GST on these purchases of $5,200. So we need to think about which ones of those have impacted inventory. Does GST impact inventory? No. So all we are interested here is the 52,000. Has this increased or decreased inventory? It has increased it because we have purchased inventory because it says credit purchase, which means that we have a debit. So let's put that in. $52,000. We know that this occurred because we're talking about at the end of this period, and it's not overly clear here, so we don't have to worry about too much it, but you do see at the bottom we're talking about 30 of June, so let's assume it was 30 June. We now need to think the other side of this transaction. What was the credit to this debit? We made a purchase on credit, which means that we owe a supplier money at a later date. No money has left our business at the moment, so we have an accounts payable liability that has increased. An increase in a liability is a credit, as you can see from Paler above, so our cross-reference is accounts payable. As we said, GST is not relevant for the inventory ledger, so we can tick that off as well. We've then, as a business, we buy trophies because we're a trophy business, then we sell them for a profit. We have sold a lot of trophies this year. We've had a good year, and we've sold 95,000, and the cost price was 43,600. We need to think about what value do we put into the inventory leaving our business. We have obviously made sales. What have we sold? We have sold inventory. Inventory being sold means our inventories goes down, so that is a credit. But which number do we do? We should instantly think from our previous work in inventory that we always record inventory at cost price. So our inventory has gone out of our building at our cost price. So we again assume that this has happened in the year, so it is 30 June, 43,600. But what is our cross-reference? You might remember that our cross-reference here is cost of sales, because whenever we make a sale, there is 5 things impacted, either accounts receivable or cash, GST clearing, sales, but then to make sure that our profit is correct, we include an expense of cost of sales and recognize that our inventory has gone down. Same deal, we don't need to even think about the GST because while it's relevant, it has nothing to do with our inventory account. So if we have done a lot of hard work, beg your pardon, and we've recorded all of the transactions apart from this physical stock take that's occurred. We've done a physical stock take at the end of the year and have realized that we have 25,700 of inventory. Now, we should know by now that the physical stock take is the correct answer of our inventory. So we need to work out how much inventory do we think we have in our ledger and compare it to our physical stock take to work out if there is a loss or a gain, because the stock take is the most accurate. How do we do this? We have enough information in our ledger to work this out. We started the year with $17,500 of inventory. You can see this in our debit side of our ledger. We then purchased $52,000 of inventory on credit. But we have lost inventory because of a good thing, but we lost it because of our sales. So $43,600 of inventory left our building. Using your calculators, you can work this out and you would realize that this equals $25,900. So we think we have $25,900, but the more accurate number is $25,700. This means we have an inventory loss of $200. What does this mean? We have $200 leaving due to an inventory loss. And we know that we did this on 30 June. Now we have enough information, absolutely, to balance this transaction. And you can see, be really careful, you need to balance this inventory ledger to finish this question off. So what do we do when we balance? We add up both sides and work out which side is the biggest. Clearly the one on the debits are bigger here, and if you total them up, they equal $69,500. So we write both of those, that number on both sides. Clearly, these two do not add up to $69,500, so we work out the difference. The difference is $25,700, and that number should make sense because we know that there's a physical stock take of that amount. So on the 30th of June, we have done a balance. And if we've done a credit, we need to obviously do a debit here. This is our $25,700 here on the 1st of the next month. We have now balanced this account to say that on the 1st of July, we have inventory of $25,700. This makes sense. Our stock take origin has told us that that's how much there is. And it all balances out in terms of our debits and credits. So that would be how we would prepare an inventory account for sales, purchases, and an inventory loss or gain. Finally, B is a word question. So we won't spend too much time on this here. Inventory losses may cost retail businesses thousands of dollars a year, and they do. So what would be two strategies you could tell management as an accountant on how they could reduce these losses? Well, if you're going to be asked for a strategy, you need to be thinking about why did this inventory loss occur in the first place? And if you've done your work in your theory, you would know that inventory losses happen to a number of reasons. One of the major reasons is theft. Other reasons include spoilage or damage. Now, it's really unlikely that a trophy has been spoiled. It could have been damaged, but let's focus on how could we reduce theft. Could you think of two strategies that could reduce theft in this business? I'm sure you could come up with lots. We could have security tags on our trophies, employ extra security guards, put more locks on our warehouses. Anything like that could be an acceptable strategy to reduce theft, which is likely the reason due to this inventory loss. So that would be how we would do 7.7. That's quite a complicated question, lots of moving parts, identifying inventory losses or gains, doing this in a ledger, so thinking about our debits and credits, but that would be the thought process on how you would complete that question.